Welcome to a critical deep dive, number 75 of the Crynet GenShow. I'm your host, and today we are covering what is undeniably the biggest black swan event of the decade. On February 28th, you woke up to a very different reality.
Yeah, a totally different world.
Right. The joint U.S.-Israeli military strikes on Iran, codenamed Operation Epic Fury, have not only decapitated the Iranian leadership, but confirmed the death of Supreme Leader Ayatollah Khamenei. As the Middle East faces an unprecedented power vacuum, global markets have just been thrown into a complete tailspin.
Decisive.
Bitcoin, acting as the world's only 247 liquidity valve, gave us a masterclass in volatility. It plunged to $63,000 in minutes before spiking back to $68,000 as the news broke. It's now stabilized around $65,900.
Which was, wild to watch in real time.
Today, we're looking at why crypto is being used as a sanctioned escape valve, how agentic AI traders handle the news faster than humans, and why the fear and greed index has plummeted to a historic low of 11. The world is at a tipping point, and the digital economy is on the front lines. Let's break down this historic week.
It was a brutal stress test for the entire financial system.
Yeah.
You mentioned that price action, the plunge to 63K, followed by the rip to 68.
Yes.
That wasn't random volatility. That was the market functioning as a global liquidity pressure valve, while traditional banks were just shut for the weekend.
It effectively became the only game in town. And looking at the on-chain data, traders were actively pricing in two contradictory risks. You had the risk-off panic of the Strait of Hormuz potentially closing.
Right, the oil choke point.
Exactly, versus the flight to safety into assets that can't be frozen by a central bank.
Precisely. It's the ultimate hedge trade. But what's really unique about this crisis compared to previous geopolitical shocks is who was actually executing the trades. The speed of that recovery bound.
The snapback to 68.
Yeah, that snapback was mathematically impossible for humans reacting to headlines.
This is where the tech gets scary good. We aren't talking about standard high-frequency trading algorithms anymore. We saw the debut of agentic marketplaces at scale. I was looking at the wallet tracking, and over 1,500 traders moved about $6.1 million into autonomous AI agent wallets just this week.
And the distinction between bots and agents matters here. Old algorithms followed basic if-then scripts. These new agents utilize the 0x cross-chain API to actually parse unstructured data.
Like the initial war report.
Right, like the strikes, they navigated liquidity across different blockchains instantly. They didn't just sell. They identified the panic wick and bought the bottom before human traders could even refresh their feeds.
So while the fear and greed index hit 11, which is extreme fear and effectively capitulation mode for human retail investors, the software was operating purely on math.
A massive disconnect.
You have retail panic on one side, but then you look at the corporate layer, and it's weirdly business as usual.
It is surprisingly resilient. Despite the war drums, you have Kraken and Ripple, valued at $20 billion and $40 billion respectively, still pushing hard for their 2026 IPOs.
They are betting that regulatory certainty outweighs geopolitical fear, which brings us to the Clarity Act. We just passed that March 1st deadline regarding stablecoin yield restrictions.
Yeah, creating a real yield showdown in Washington right now.
It feels like a split-screen reality. Kinetic warfare in the Middle East and regulatory trench warfare in D.C.
Right. Both are shaping the infrastructure. And infrastructure is the key word here. The Ethereum Foundation just confirmed the Glamsterdam upgrade.
Right, specifically the push for war-proof nodes.
Exactly. They are pushing PeerDAS and account abstraction. PeerDAS allows nodes to verify the chain without downloading the massive history file.
So if the big centralized data centers go dark due to conflict,
the network can persist on much lighter hardware, like laptops.
Which is a necessary evolution because we saw exactly what happens when you rely on centralized databases this week in South Korea. The National Tax Service breach wasn't just a glitch.
No, it was a systemic failure. 4.8 million PRTG tokens were stolen because the data was centralized in a government-mandated backlog.
It reinforces the entire thesis of the last week. Centralized points of failure, whether they are Iranian command centers or South Korean tax databases, are vulnerable.
Highly vulnerable.
We're closing out deep dive number 75 in a world that looks very different from the one you occupied just 7 days ago. The strikes in Iran and the death of Khamenei are events that will be studied for decades.
Absolutely.
But for us in the crypto space, the takeaway is clear. In times of absolute chaos, decentralized assets are no longer just digital gold. They are critical infrastructure.
Whether it's Iranians using crypto to preserve their wealth or agentic DeFi protocols maintaining liquidity when human traders are in shock.
The tech is holding up. But you must stay grounded. With oil prices surging past $82 and the Clarity Act transition facing a yield showdown in Washington, the road ahead is anything but certain.
Not at all.
You can find the full timeline of Operation Epic Fury and the market impact reports in our show notes. This is a week to keep your assets secure and your eyes on the macro picture. Before we go, just consider this. What happens when these autonomous agents start writing their own smart contracts during the next geopolitical blackout? Just something for you to mull over. Stay safe, stay vigilant, and I'll see you, hopefully in a calmer world, for Deep Dive number 76.